Thank you for tuning in to All Things Real Estate. Once again, here are your hosts, Brad Avergon and Gary Kelley.
Brad, welcome back to the second part of the show. If someone wants to reach you, how can they do that?
Best way to reach me, Gary, is via my cell phone, which is 978-375-5531, or they can email me at brad@bradavergon.com. That's brad.avergon.com.
And I'm reachable at 508-733-6005. And I'm Gary at Move with Gary. And I want to remind people who would like to know how they consume our content. Just send a text or whatever and let us know. And if they'd like to have an old school calendar, this is for 2013.
That is a collector's.
I'm sorry, 2023. Oh my God, I just dated myself. If they'd like to have that as a consolation prize, by all means, let us know. That's one thing. One of the other things that's going on, though, in the real estate market is people are saying, buyers are not buying. And I see that, for a lot of people, affordability has become a massive issue.
Yeah.
What are your thoughts on that, Brad?
So I think it has for a certain amount of people that were kind of pushing the envelope before. I think there's some things that folks can do to help a little bit with it, but definitely it's something to be considered, because let's face it, if you were looking at interest rates at, even 4%, which was higher than where we were at Lowe's a year ago, and you're looking for the same type of mortgage, that mortgage may cost you, close to, $1,000 more a month if it's a good, $400,000, $500,000 mortgage. So you have to weigh and measure these things. But ultimately, the way I counsel my clients is it's about comfort zone. It's not just about what the bank says you can afford or you can't afford. It's about comfort zone with that monthly payment. And how can we get that monthly payment into a place that you're comfortable with, that you're going to be able to make this monthly payment? And there's a couple of ways that I think people can do to make these new payments more comfortable. We can't control interest rates. You can't control them. I can't control them. But this is the new now, right? This is the new reality that where we are. And interest rates are going to be for a little bit anyway between that 6 and 7% range. We did get a lot of relief last week. We had a market movement a bit, and so now 30-year fixed rates are closer to the mid sixes, which is a nice place to be. But that's still a big jump up. I think some of the things they can do is they can look at, adjustable rate mortgages for 5 and 7 years, which gives them enough time. That's the average life of a mortgage, is about 5 to 7 years. And then people either move or they redo them. So it's a great way to take advantage of that. And some of those adjustable rate mortgages are lower. And they're fixed for that 5 or 7 year period of time. The other thing for those folks that are more conservative, and I tend to be in the more conservative side, is they can get a buy down. They can get a temporary buy down whereby the rates and the payments would be based on an even lower situation. So for the example, let's just say rates are at 6.5% right now. Let's on a no point 30-year fixed. You could have someone start off at 4.5% year one, 5.5% year two, and 6.5% year 3 through 30. And we could try to build that into the financing and build it into the purchase price a little bit, with a little bit of communication and cooperation between the buyer and the seller, and obviously keeping the agents abreast of it. So there's some techniques that can make that property come a lot closer to where it was, at least, for the time being, and help people get into the home and again, be comfortable with that payment and be able to grow with the property.
Grow with the property?
Grow with the property. Yeah. Let their income go. What I mean by that is, so if you expect a 3% cost of living increase year after year, and we're talking about a 1% increase in your monthly mortgage payment, that might be digestible. When I translate that to dollars and cents to people, oftentimes it's a couple of $100 a month. It's nothing that's going to be drastic, and they're okay with that.
Well, I think that I personally am not a huge fan of the buy down programs. That's me. I don't like the seller having to kick in, although I understand that in many cases it's a better opportunity for the seller than doing a price reduction. So, that's the trade-off. I like the idea of an adjustable rate mortgage. I think not all, but I'm sure, but many of the issues that were with the adjustable rate mortgages in the 80s have been tempered by laws and some more common sense entering the marketplace. But that's always a challenge for people. I know that one of the things that Lamacchia has been talking about is assumable mortgages. VA, USDA, FHA loans are generally assumable. And as a result, if you're in a position of taking over someone's mortgage, and there's obviously a lot of work that has to go into making that happen. It's not a simple process. There's extra steps involved, but you can get one of those low mortgages and and just carry on with the mortgage.
So there's there are absolutely some pros to that. And it's funny, those government programs, those FHA loans insured through the Federal Housing Administration, that's what FHA stands for, and the Veterans Administration, the VA loans, and the USDA loans, those have been assumable for a long time, but very few people even inquired about them because rates were on the down. They were sliding down. So if somebody took a couple of those mortgages a few years earlier when they originally bought the home, there was no reason why you would even want to assume that mortgage. But now, with what you're talking about, yes, those rates are lower. But here's the thing. It depends on how old those mortgages are, because yes, you can assume those mortgages at the current balance that they have now, right? So if they've had that, let's just use an example, an FHA loan for a long time and the balance is really reduced, your buyer has to come in with a substantial down payment. They can't just jack it back up to 96.5% financing. So you have to kind of weigh and measure that. Now, if it's one that they got a year or two ago, the odds are that that mortgage could be pretty high, and depending on what they're looking for the sale of that property, it may be a very profitable for both parties opportunity to put a deal together.
So, Brett, I'm going to ask you a question that's going to put you on the spot, and I like doing that. If you look at the people that are buying homes today, your clients, this is not a nationwide sample,
right?
Your personal client base, generally speaking, what products are they using right now?
I would say my clients are using 30-year fixed.
Really?
Yes. There's certainly more interest in adjustable rate mortgages than there was a year ago, certainly way more. But if you said, what's the ratio? I would say at least 50% are using 30-year fixed. Some of them are using buy downs. I had a client the other day that was where the buyer was going to pay the buy down because they're on a fixed income situation, and rather than have to worry about taking the money from savings every month, they decided they were going to fund it themselves and set it up, because based on they knew their fixed income was going to be increasing over this so much every year. They set it up so that they could be comfortable, and they said, we'll take the lump sum right now, we'll set up the buy down, and it's fix it and forget it. And as much as I agree with you in the sense that I think adjustable rate mortgages are a great tool and they make a lot of good financial sense, at the end of the day, there's a huge portion of this which goes to a buyer's mindset after they take ownership of a home, and they want to feel safe. They can't control their taxes. They can't control what the cost of their insurance is, but they can control what their monthly payment is. And that's why people, when push comes to shove, a lot of times they'll go with that 30-year fixed rate with the understanding that, hey, if rates drop, we'll refinance you. If they drop 1% or so, we'll refinance you. And if they don't drop, you can sleep at night knowing your principal and interest is never going to change.
Right. I know that when I got my first mortgage, it was back in the early 80s, it was 18%. It was an adjustable rate mortgage, and every year it adjusted down. I felt pretty good about that. But as much as I felt good about that, you also had the horror stories of people where it was adjusting up and they couldn't afford the home anymore. And that's just horrible.
Yeah. Yeah. And there's a lot, you know what, we're at the bottom of that curve, right? We took a long ride to get down to the rates where they are. I started in this business in 1987 and rates were 13%. Okay. And it was a long ride down to where we were last year. Okay. But now I believe we're going to be on the upswing, at least to a certain extent. We're not going to be down where they were. And so you don't want to be in that place that you were talking about where your mortgage payment is going up every 6 months. You know, most of the ARMs that are out there, the adjustable rate mortgages, they use SOFR, which is a new index. They used to use what's called the LIBOR index, but that index got discontinued, and some use the Treasury. But the SOFR is adjustable every 6 months. So the fact that a person's payment can adjust every 6 months after that fixed period of time, so it's fixed for 5 years, which is great. If you can get out of it in 5 years, fantastic, all the better for you. But after that, do you want your payment changing every 6 months? A lot of people are nervous about that. So
I would not be comfortable with that. That's just me.
yeah, nor would I.
Yeah. So, Brad, I want to take a minute and thank you for your help in doing this show on a monthly basis, and to wish you a happy fill in the blank, whatever works for you. I know in your case, it's Happy Hanukkah. In my case, it's Merry Christmas. Mm-hmm. But I also respect that there are a lot of other people out there that do different celebrations, especially Festivus, which I think is always an intriguing one when you see people do the posts for Festivus. But anyway, happy end of the year, and we will see you again in the new year.
Happy end of the year, and we'll see you next year, Gary. And to our listeners and viewers as well, happiness to you and your family. And there's so much to be grateful and to be happy about. Stay focused on that, and we'll see you again next year.
Once again, thank you for watching All Things Real Estate. If you have any questions, feel free to reach out to Brad or Gary.